Maurice Nazarian. I'm an assistant portfolio manager at Oaktree. I'm the co-PM on our asset-backed finance fund. And I spent my whole career in securitization and fixed income. However, it's been mostly in micro as opposed to macro. And I'd love to talk to you more about that part that I know best of. However, I think macro evolves and affects some of the activity we do. However, I'm not a macro projector, so I'm not going to be very good at projecting interest rates or anything like that. I can tell you how this could affect some of the portfolios in private alternatives, especially in private credit. But as you think about an allocation, even like as a private wealth like investor and individual, you have, as my friend Josh would say, a very big menu like you would at the restaurant. And you got to spice it up with some of the condiments that are there and maybe pair some wine and all that stuff. I see private alternatives as a main meal, if you will, within which you can choose whether it's private equity, private credit. You can add some VC, venture capital, and some infrastructure and real estate, right? When you think about where we are in interest rates, and we're coming out from a period of time, 14 years of very, very low interest rate, near zero, a lot of the strategies within private alts, like private equity and VC and real estate, have performed extremely well because they were able to borrow very cheap interest rates, right? And then since 2022 and QT with Federal Reserve raising the rates, shrinking the balance sheet, a lot of that has changed. And it's harder to really monetize what you have in private equity and VCs and real estate equity. And when you look at the past 14 years, you think of yourself as an allocator, where maybe the strategies within private alternatives that have performed very well the last 14 years will be different from those that will come next. Obviously, you'll still have some of the best managers that will do in every of these strategies, the good situation pickers, but a private credit allocation seems to be in a higher interest rate environment for longer, a judicious additional allocation. And then private credit has been really formed and developed and grown really over the last 20 years, but seriously after the great financial crisis, when Dodd-Frank rules were implemented, when banks really started to go away from lending to middle market companies in senior secured positions. And so that left a blank canvas for senior direct lenders and non-bank lenders to step in, which led to a $1.5 trillion private credit market today. What is very interesting is that we've achieved a pretty mature stage of the direct lending area in private credit. But what's very interesting is that with QT, with some of the aversion of banks in putting loans on their balance sheet and keeping them for longer, as well as some of the Basel III endgame and the higher capital charges that impact some of those banks, there are a number of banks and a lot of regional banks that are withdrawing from asset-backed finance activity. And so that has left a new investable for non-bank lenders to pursue, which is basically a private version of, for those of you who know, liquid structured credit in that performing private credit area of asset-backed finance, which is available at premium because there's not as much capital has been raised to go after that, and there's plenty, and there's a big gap of demand, of a big gap of capital that needs to be filled in. So we're very excited about all kind of private credit, honestly, a little bit concerned on some part of private credit, and we have actually a distressed opportunistic credit part at Oaktree that is allowing to invest in this area, but ever so in asset-backed finance where you can add alpha to your private credit allocation.